How do we calculate the DSCR? It is calculated as follows. When the company increases the debt, the financial risk faced by the equity shareholders also will increase. What do we mean by capital structure? It is the mix between the owner's funds and the borrowed funds. Hello everyone, I am Purnima, faculty in the Department of Commerce and Management, Vidyashram Pre University College, Temple of Excellence, Mysuru. I welcome you all to this session. In this session, revision class session 2 on financial management, we will be learning about the capital structure and what is fixed capital, what is working capital, and what are the various factors affecting the fixed and working capital. Now, from the examination point of view, I want you to just study the fixed capital, working capital, and also the factors affecting fixed capital and working capital. Please make a note of it. It may come for 4 marks or it may come for 8 marks. So please be prepared for this chapter. Now, let us understand what is the meaning of the word capital structure. It refers to the mix between the owners and the borrowed funds, and these should be referred as equity and debt in the subsequent text. So, what do we mean by capital structure? It is the mix between the owner's funds and the borrowed funds. So, these shall be referred as equity and debt in the subsequent text. Now, this equity capital, it is the owner's funds. Then, next will be this. These are the borrowed funds. These are also the owner's funds. So we can say that capital structure is a mix between the owner's funds and the borrowed funds. It can be calculated as debt equity ratio, and the debt equity or as the proportion of the debt out of the total equity. So debt plus equity. Debt and equity differ significantly in their cost and riskiness for the firm. So, we call this as the debt and this is the equity. So, the proportion of debt and equity make up the capital structure. Next, let us understand what are the factors which affect the capital structure. The first one is the cash flow position. So, in the cash flow position, the size of the projected cash flows must be considered before borrowing. Cash flow must not only cover fixed cash payment obligation, but there must be sufficient buffer also. So, when we are thinking about the capital structure, we have to think about the first factor to be considered as the cash flow. So, the cash flow must be more than what is the installment you have to pay to the banker. So, there should be a sufficient buffer. So, it should not only cover the installment amount, but it should also cover something extra. Then, the second is the interest coverage ratio. So, it refers to the number of times earnings before interest and taxes of a company covers the interest obligation. So, the interest coverage ratio means it refers to the number of times the earnings before interest, that is EBIT divided by interest. So, this is equal to ICR. So, the interest coverage ratio. Suppose the earning before interest and taxes is 2 lakhs and the interest is 10,000. Then the ICR ratio will be 20%. So, 20 times it is covering. So, next one, the debt service coverage ratio. So, it takes care of the deficiencies referred to in the interest coverage ratio. The cash profits generated by the operations are compared with the total cash required for the service of the debt and the preference share capital. So, in the debt service coverage ratio, we will be considering the cash profits generated by the operations along with the total cash required for the service of debt and preference capital. So, how do we calculate the DSCR? It is calculated as follows. First one is profit after tax plus depreciation plus interest plus non-cash expenses divided by preference dividend plus interest plus repayment obligation. So when we divide this, we get the debt service coverage ratio. Then the next factor affecting the choice of capital structure is the return on investment. If the return on investment of the company is higher, it can choose to use trading on equity to increase its EPS. That is, its ability to use debt is greater. So, the return on investment means that is if it is choosing to trading on equity. So, what do we mean by trading on equity? It is increase in the equity shareholders' income by using the debentures. So, that is trading on equity. So, its ability to use debt is greater. That means if you are having very good earnings, suppose you are having a earning of 20 lakhs, out of this paying an interest of 20,000 is not a very big issue. So, we have to see what is the return on investment we are getting. Then the next one is the cost of debt. A firm's ability to borrow at a lower rate increases its capacity to employ a higher debt. So, the firm must be able to employ its borrow at a lower rate. So, you have to borrow at a lower rate so that it will employ a higher debt. Then the tax rate. Since interest is deductible expense, the cost of debt is affected by the tax rate. The firms in our examples are borrowing at 10%. Since the tax rate is 30%, the after-tax cost of debt is only 7%. So, the tax rate means since the debenture interest, whatever we are paying to the debenture holders, it is a deductible expense to calculate the profit. So, it will be better for the firm to go in for a debentures because whatever expenditure we are paying for the debenture holders, it is a deductible expense. Then, the next one is the cost of equity. Stock owners expect a rate of return from the equity which is commensurate with the risk they are assuming. When a company increases debt, the financial risk faced by the equity holders increases. So, the stockholders expect a rate of return from the equity which is commensurate with the risk they are assuming. So, the rate of return and the risk should be proportionate. So, when the company increases the debt, the financial risk faced by the equity shareholders also will increase. Then, the next one is the flotation cost. The process of raising resources also involves some cost. Public issue of shares and debentures require considerable expenditure. Now, what do we mean by flotation cost? Flotation costs are those costs which are incurred for issue of equity shares, for issue of preference shares, or for the issue of debentures. So, it may be appointment of the merchant bankers, then appointment of the underwriters, then advertisement expenses, approval from SEBI. So, there are a lot of procedures involved and also a lot of expenses involved. So, all those expenses incurred by the company for the issue of shares and debentures, we call them as flotation costs. So, if the flotation costs are too high, it will be best for the company not to go in for the issue of shares and debentures. Then, the next one is the risk consideration. Use of debt increases the financial risk of a business. It refers to a position when a company is unable to meet its fixed financial charges, namely the interest payment, preference dividend, and repayment obligations. So, we have to just think about the risk consideration. What is the risk consideration? It refers to a position where the company is unable to meet the fixed financial charges. Now, what are these fixed financial charges? It is the interest payment, preference dividend, and repayment obligation. So, when it is unable to meet its financial charges, then we say that the company is in a state of financial risk. Then, 10th one is the flexibility. If the firm uses its debt's potential to the full, it loses flexibility to issue further debt. So, if the firm is issuing lot of debt, then what happens is it cannot raise any other money through the issue of debt. To maintain flexibility and maintain some borrowing power to take care of the unforeseen circumstances. So, the company should set aside a part of the debt as it is and to see that under circumstances it can make use of that part of the debt to meet its financial requirements. Then, the next one is the control. The debt normally does not cause a dilution of control. A public issue of equity may reduce the management's holding in the company and make it vulnerable to takeover. Now, in case of control, if you think about the control consideration, it is the equity shareholders who will be having a dilution of control. Whenever a company makes a fresh issue of equity shares, the control of the company will be spread over so many shares, as a result of which the existing shareholders, they will be losing control over the company. Then, next one is the regulatory framework. Every company operates within a regulatory framework provided by law. Example, public issue of shares and debentures have to be made under SEBI guidelines. So, SEBI guidelines are there, and for them we have the public issue has to be made. Raising funds from banks and other financial institutions require fulfillment of other norms. So, if we have to borrow from the SEBI, that is raising funds from banks and other institutions, we have to get the approval of SEBI and also we have to follow the SEBI guidelines. Then, the 13th one is the stock market consideration. If the stock markets are bullish, equity shares are more easily sold even at a higher price. Use of equity is often preferred by companies in such a situation. When the stock market is bullish, that is, when the prices are rising, then it means that there will be a rise in the prices, as a result of which the companies can go in for issue of equity. However, during a bearish trend, the company may find raising equity capital more difficult and it may opt for debt. So, if there is a bearish trend, that is, people keep on selling the shares. So, if there is such a trend in the stock market, the company can go in for a debt option. Then, 14th one is capital structure of other companies. A useful guideline is the capital structure planning is the debt equity ratio of other companies in the same industry. There are usually some industry norms which may help. So, if you can see here, some of the companies, they'll have 50% equity, 25% preference shares and 12.5% as the debt. So, their different ratios are there. So, based on the different ratios of different companies, we can decide about the capital structure of our company. Then, let us understand the next concept, that is the fixed and working capital. Fixed assets are those which remain in the business for more than 1 year, usually for a much longer, that is, plant and machinery, furniture and fixture, land and building, vehicles, etc. So, the fixed assets remain in the company for a very long period. Next, let us understand what we mean by fixed capital. So, it's the management of fixed capital or investment or capital budgeting decision are important for the following reasons. So, why we need fixed capital and what are the various factors which affect the fixed capital are, the first one is the long-term growth. The funds invested in long-term assets are likely to yield returns in the future. These will affect the future prospects of the business. So, for the long-term growth, so if you want to have a long-term growth in the business, then it will be best for the company to have fixed assets, that is land and buildings, plant and machinery. So when once it's a one-time investment, so you invest once in all these fixed assets, then they will be yielding the benefit throughout the lifetime of the company. Then second one is large amount of funds involved. These investments are planned after a detailed analysis is undertaken. It may involve decisions like where to procure the funds from and at what rate of interest. So there is an involvement of huge amount of funds. So whenever we have to purchase a land and building or a plant and machinery, then there will be huge amount of funds involved, and this a huge amount of funds, whether to just purchase these assets or whether to take it on a lease. So that will be the question before the management, and it involves decision like where to procure the funds and at what rate of interest. Then the third one is the risk involved. Investment decisions involving fixed capital influence the overall business risk complexion of the firm. So whatever the firm decides for investment purposes, so it will influence the business risk of the firm. So we have to take important decisions before we make an investment. Then irreversible decisions. These decisions once taken are not reversible without incurring heavy losses. Abandoning a project after heavy investment is made is quite costly in terms of waste of funds. So these kind of decisions where you are making investment in land and buildings, plant and machinery, etc., it involves huge amount of money. And once you make the decision, so once you have purchased the land and building and plant and machinery, whatever, so you cannot reverse the decisions. That is, it cannot be easily sold also. So that is why we have to take a most care whenever we take such investment decisions. Then let us next see what are the various factors which affect the fixed capital. The first one is the nature of the business. The type of business has a bearing upon the fixed capital requirement. So that is, if the business is engaged in a manufacturing, if it is a manufacturing concern, then it needs more fixed capital. So why? Because it has to make investment in land and building, plant and machinery, furniture and fittings. Lot of fixed assets are needed. But if it is a trading concern, they don't need much fixed assets because they'll be just buying the goods and selling the goods. So they, as such, there will be no need for greater fixed assets in case of a trading concern. Then the second one is the scale of operations. A larger organization operating at a higher scale needs bigger plant, more space, etc., and therefore requires higher investment in fixed assets when compared with the small organization. So a large organization, so if it is a very huge organization, then they will need more of fixed assets. So they will need a very big space to run the business. They will need more machinery, more furnitures, etc., to accommodate all the people. But then if it is a small organization, then it will be a small space and a few number of workers, etc. So that is why, so depending on the scale of operations, the fixed capital we have to decide. Then third one is the choice of technique. Some organizations are capital intensive, whereas others are labor intensive. So a capital intensive organization requires higher investment in plant and machinery as it relies less on manual labor. The requirement of fixed capital would be higher. So if you are resorting to a capital intensive industry, then there will be greater investment in plant and machinery. So you will be relying less on manual labor. But then if it is a labor intensive industry, then you don't need much infrastructure because almost all the work will be done by the labor itself. So the fixed capital requirement will be less. Then fourth one is the technology upgradation. In certain industries, assets become obsolete sooner. So higher investment in fixed assets may therefore be required in such cases. So sometimes whatever the machinery we have purchased, it may become obsolete or outdated. So in that cases, again we have to make an investment to purchase the latest version of the machines, and as a result of which we may need huge fixed capital. For example, computers become obsolete faster and are replaced much sooner than the furniture. Then the next one is the growth prospect. Higher growth of an organization generally requires higher investment in fixed assets. So even when such growth is expected, a company may choose to create higher capacity in order to meet the anticipated higher demand quicker. So growth prospect means the higher the growth of the organization, if the organization wants to have a very high growth, then it is necessary for it to make high investment in fixed assets. So when they have a good investment in fixed assets, they can automatically increase the capacity of the machine and then they can produce more. So in this way, it will help for the growth of the organization. Then the next one is the diversification. A firm may choose to diversify its operations for various reasons. With diversification, fixed capital requirements increase. The textile company is diversifying and starting a cement manufacturing company. So what is this diversification? A company, an existing company which is involved in textile business, so it wants to start a cement business. Then what happens? So everything has to be purchased newly for the new business. So as a result of which the fixed capital requirement will be high. Then the next one is the financing alternatives. A developed financial market may provide leasing facilities as an alternative to outright purchase. So when an asset is taken on lease, the firm pays lease renters and uses it. By doing so, it avoids huge sums required to purchase it. So the financing alternatives means, so we have to see what are the various alternatives available before the company. So whether they want to go in for outright purchase or they can have the asset on a lease or a rent basis. So in this way, we can just see what they are the factors which affect the fixed capital. Then the next one is the level of collaboration. Certain business organizations share each other's facilities. A bank may use another's ATM or some of them may jointly establish a particular facility. This is feasible if the scale of operations of each one of them is not sufficient to make full use of the capacity. So whatever facilities are available, they should be made full use of, because if there is an understanding between the banks, then any bank can use, the account holder of any bank can make use of any one of the ATMs. So this is because of the level of collaboration between the banks. So this, if there is a high level of collaboration, this will greatly reduce the requirement of fixed capital because banks need not open ATMs all over the country. Then, apart from the investment in fixed assets, every business organization needs to invest in current assets. This investment of facilities smooth day-to-day operations of the business. Current assets are usually more liquid but contribute less to the profits than fixed assets. So, working capital means, how do we get working capital? Current assets minus current liabilities equals working capital. Now, this working capital is required for the smooth running of the business. So, whatever the day-to-day expenses of the business, they are taken care of by the working capital, and it is with the help of the working capital we will be able to purchase the current assets. Then, let us understand what are the factors which affect the working capital requirement. See, this is an important question from the examination point of view. Please make a note of it. So, here, what are the factors which affect the working capital? First one is the nature of the business. Again, if it is a manufacturing concern, you will need more capital, working capital. But if it is a trading concern, then the capital requirement will be less. So, a smaller amount of working capital to a manufacturing organization and service industries which do not have to maintain inventory requires lesser working capital. So, for manufacturing industry, more working capital. For the service industry, less working capital. Then, second one is the scale of operations. For organizations which operate on a higher scale of operation, the quantum of inventory and debtors required is generally high. So, in case of a higher scale of operation, the stock required will be high, and as a result of which the debtors required also will be high. Next one is the business cycle. Different phases of business cycle affect the requirement of working capital. Now, what are the business cycles here? So, we have the inflationary period. Then after the inflation, it is the boom period. And after the boom period, there is deflation. And then there will be a depression. Then we have the recovery. So, this kind of a business cycle will be there. So, during the inflationary trend, the working capital, so the rate of everything will be high, and as a result of which the working capital required also will be very high. Then next one is the seasonal factors. Most businesses have some seasonality in their operations. In peak season, because of higher level of activity, larger amount of working capital is required. So, during the seasons, if there is a very good season, then there will be more need for more working capital than during the off seasons. Then let us see, next one is the production cycle. So, it is the time span between the receipt of raw material and their conversion into finished goods. Duration and length of the production cycle affects the amount of funds required for raw materials and expenses. So, if you can see here, this is the production cycle. So, the producer is there. So, from the producer, reintroduction in production cycle, recycling, separation by categories, disposal, collection, etc. So, in the production cycle, so we will be ordering the raw materials which goes into the machine, and from there we get the finished product which will be reaching the hands of the consumer, and then again the company will get back its revenue. So, the production cycle refers to the period between which raw material takes to get converted into a finished product. So, working capital requirement is higher in firms with longer processing cycle and lower in firms with shorter processing cycle. So, if the processing cycle is between 3 months, etc., then all the money which is invested in the stock, it will be held up for 3 months. So, we have to wait for 3 months to get the process converted into a finished product. But if it is a shorter working cycle, then we need not have much working capital. Then the next one is the credit allowed. Different firms allow different credit terms to their customers. These depend upon the level of competition the firm faces as well as the credit worthiness of their clientele. A liberal credit policy results in higher amount of debtors, increasing the requirement of working capital. So, when we are giving lot of loans to the customers, what happens is, so our requirement of fixed capital will be high because there will be lot of sales, but the revenue comes in at a later date. So, as a result of which, to meet that gap, we need to have more working capital. Then the next one is the credit availed. Just as a firm allows credit to its customers, it also may get credit from its suppliers. To the extent it avails the credit on purchases, the working capital requirement is reduced. So, if the firm is able to get some time to pay for the suppliers, the working capital requirement will be less in that case. But if they don't give us any time to repay the money which we have borrowed from them, then the working capital requirement will be high. Operating efficiencies. Firms manage the operations with varied degrees of efficiency. So, how efficient they are in the operations of the company, it will decide the working capital of the company. Then availability of raw materials. If raw materials and other required materials are available freely and continuously, lower stock may suffice. Larger the lead time, larger the quantity of material to be stored, and larger shall be the amount of working capital required. So, if there is an easy availability of raw materials, then the company need not stock it, because whenever it needs, it can go to the market and purchase the raw material. But if the raw materials are scarce, then they will have to stock it, because if there is any scarcity of raw material, then the entire production house will come to a standstill. So they will need more working capital to purchase the raw materials and stock it. So depending on the availability of raw material also, the working capital requirement is decided. Then the next one is the growth prospect. If the growth potential of a concern is perceived to be higher, it will require large amount of working capital so that it is able to meet higher production and sales target whenever required. So, if the growth prospects, if the company wants to increase its sales, then what happens? They will need more working capital. So, in order to meet the additional sales, whatever they are having, so in order to get revenue, the company has to invest in the production of those products which requires more working capital. Then, next one is the level of competition. The high level of competitiveness may increase larger stocks of finished goods to meet urgent orders from the customers. So, if they are having lot of competition in the market, then the company should resort to have larger stock of finished goods, so in order to meet the customers' demands. Then, next one is inflation. With rising prices, larger amounts are required even to maintain a constant volume of production and sales. The working capital requirement of business thus becomes higher with a high rate of inflation. So, this high rate of inflation is trend wherein there will be a rise in the prices of goods. So, the firms are expected to have a huge volume of stock of products. So all this to maintenance the stock of products also, a huge working capital is required. With this, we come to the end of this session. Hope you have all followed it. Thank you. Please make a note again. So the fixed capital, working capital, capital structure, three important concepts you have to study from the examination point of view. Thank you.